Hello, everyone. We are back for another session this Tuesday, today on your cash flow statement. So, really looking forward to the conversation today with my special guest, Leonard Brooks. So, of course, before we get started, we have to do our little fun disclaimers here. So, again, the information is not intended as tax, investment, or legal advice. Make sure you are talking with your professionals about your specific situation. But again, we're here to help take calls and would love to talk to anyone about anything they have in particular they want to talk to. So without further ado, I will bring on Mr. Brooks. Brooks,
Hi, how are you, man?
I am fine, sir. How are you today?
Hey, man. Good Tuesday, man. Glad to be here.
Good. Well, first, y'all, I got to thank Leonard for taking time out today. He's actually off this week, and he's doing the granddad thing. So he took some time out to join us today and
Yeah,
talk a little bit. So
running the movie.
yes, exactly. So before we get the presentation pulled up, Leonard, if you don't mind, tell us a little bit about your two practices. Actually, it's two practices that you operate. So if you can tell us a little bit about what you do on a day-to-day basis, we'll talk a little bit
Absolutely.
about how we help each other, and then we'll get into the presentation.
That's right. Right, right. Hey, got into the insurance business right after college. I'm a proud graduate, St. Augustine's University. Falcons fly high. Um, Started with Jefferson Pilot in Charleston, South Carolina, which is where I'm from. I moved back to North Carolina in '94 and worked with American Express as an advisor and then Nationwide Financial. So I opened up my own practice in 2005, Brooks Financial, where of course we focus, on retirement planning, investment planning, insurance planning, um, and so we were going, and we've been going since '05. Um, in 2018, met up with a good fraternity brother and good friend of mine that I knew at St. for many years, and he or he has over 30 years experience on the middle market commercial side. So what we decided to do is take the small portion of the Brooks Financial practice that was focused on that risk management and
Mm-hmm.
just create Alpha Risk Management, which is the
Mm-hmm.
name of our agency. MWBE certified, combined, over 40 plus years of experience working with small businesses. So what we wanted to be able to do is do holistic planning all the way around, from a
Mm-hmm.
personal financial side to a business risk and business financial side as well. So
Awesome.
we're still growing that, and it's coming along well, man. And just look forward to many years.
Good. Awesome. Yep. And so, it's funny, we're in that same space. So a lot of people would kind of seem as weird that we're talking and helping each other. But one thing both of us realize is that there's no way for either one of us to serve every client that's out there. So why wouldn't we help
Absolutely,
each other grow and share things? So
absolutely.
so we've been working together. I don't know. I was back on Highway 55. Gosh,
Mm-hmm. Yeah.
ooh, 10, 10, 12 years ago. So it's been a
Exactly.
minute.
I want to say about 12 years ago.
Yeah, about
Yeah,
12 years.
it's funny. We created our own peer group. We had to,
Exactly,
and
exactly,
and,
exactly.
and being in this industry for the length of time that you and I have been and traveling to these different agencies, we knew, and we still know that there was a need, strong
Absolutely.
present in our community for planning and retirement
Right,
services, et cetera. So yeah,
right.
we've been working together for a while.
Yep. So again, that's what I was been seeking to do is kind of bring a lot of the professionals on that I work with for everybody to meet and see
Mhm.
kind of some behind the scenes of what we do. So let's get into the presentation today.
Gotcha, gotcha.
Yep. So our cash flow statement. We're gonna chat a little bit about that today. I'm not big on talking about me. That's me. We'll keep going. Leonard's done his introduction, so we can kind of skip that and get right into it.
Absolutely.
So they like to start these presentations, and again, we can't take credit for writing these presentations. They are written for us for compliance reasons. But I like to start off with some fun facts. So just some facts here about money, its size, how much it weighs, and how many notes are out there with a face value of $356 billion. That's pretty interesting to know how much money is
Mhm.
actually floating around in our economy. But here we go. Let's get started. So what we're going to seek to do today is kind of give you guys some examples of different things to help improve your cash situation, improve your finances, use money wisely, why things are important, such as inflation, credit scores, things of this nature. So, and Leonard and I will talk about how we look at these as case studies and kind of help people. So they start us out with this case study, say on credit score advantage. So this example here, it is a person who has a $400,000 loan with a 30-year fixed rate. Um, we've got the two different credit scores on there, 760 versus 620, and you can see the difference in the rate that is afforded to the people, the applicants, the difference in the monthly payment, and what that amounts to over the life of a mortgage. So Leonard, as we're talking about this here and that difference, that credit score difference, the
Mhm.
per month and the life of the mortgage, we're talking about $130,000. Now our next
Absolutely.
thing becomes what? Opportunity costs, right?
Right. Right. Using those proceeds over the years and missing out on, making those additional 401k contributions, making those additional Roth contributions, investing that extra money into your business. So, it's some of the smaller things that actually can affect that bigger picture.
Exactly. And then like I said, it's important, and we're always probing on this information as to um, understanding one, what our clients are trying to accomplish, what's important to them. Some people are debt averse, some people can handle it. So depending upon that, that $363 goes a long way to credit card or a
Right.
car payment. But again, ultimately our wealth goals and what we're trying to accomplish, a 529 plan or sending the kid to college. Those are big things that we're always talking about. Um, all right, so let's move on to the next thing here. Um, all right, risk return potential and how we are looking at that. So this chart here is kind of just designed to break down our basic types of things. Now we'll start this conversation off with speculative investments, and I'm gonna pose a question to Leonard. Leonard, what's the biggest speculative investment that you are dealing with right now with your client base? Ding, 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 ding. Can I get an answer?
Oh gosh. Um, the biggest speculative investment, I would, with my client base and just in general, Marcus, and I hope we're going in the same direction. What's been kind of chiming at me is just looking at, your hedge fund strategies and how they have been performing, and of course, people always want to come in and they want to go straight to the top. But once we do
Mm-hmm.
the risk profile, it always shows them right there in the middle or closer to the fixed interest bonds area. So,
Mm-hmm.
um,
Mm-hmm.
I, I would say, just the equity portion of what
Right.
we're doing provide is, at this time for my base,
Mm-hmm.
provides more of that speculative. Um,
Now the yeah, I agree with you on that piece in terms of
mhm,
hedge funds and the
mhm,
different types.
mhm,
And one thing, we both have many clients that we use a common portfolio strategist, and we've had that conversation with them about hedge fund strategies and
mhm.
and liquidity. So we get
Right.
stuck with liquidity, especially if it's a real estate hedge fund and things of that nature, and you can't get your cash out. But the other big
Mhm.
one, of course, that has been the craze. We
Okay,
got
okay.
and we got
I'm sorry. Look,
and we got
it's
few,
late, but let's go back to the bitcoins in the
yeah,
in the that
on
e currency.
on the tax return. I think they call it digital assets.
They do. assets. Exactly.
Digital
Exactly.
assets. So, you know, I know we've talked and we've got a lot of clients who are in that space and want that space.
Mhm.
But of course, again, like I said, it goes back to our risk tolerance
Right.
and how do we and how we create that opportunity for them to participate in that. So we're not here saying it's wrong, but what we're saying is, um, first we want to cover our bases in the more traditional things that one are, with cash, we actually have some FDIC protection, which we'll get into later. Where that Bitcoin is speculative, and if we have the wrong strategist trading, it's gone.
Right.
Um, right. So so again, that's back to that planning piece where we've got to give the solid plan first, and then we give you some play money once we can say, yeah, we've dedicated this amount for your plan, and then here's your money to go kind of play with. But that's an integral part of the conversation a lot of times is that risk management, and it's become I think more dominant now that it's out there, and that people are wanting to use that and delve into it and see where it goes.
And it still has, like you just mentioned, it has its place. There's a space for it, but
Hmm.
you really have to understand your risk tolerance
Hmm.
to determine what portion of your portfolio, or if any portion of your portfolio, should have digital assets. And
Hmm.
again, going back to the big P, that's where the planning comes in.
Hmm.
Knowing your temper.
Hmm. Hmm. All right, so we'll move on. So here's an interesting chart on what things have looked like lately from a debt and savings standpoint. And as you can see, a key thing there is 2020. As we kind of got into 2022 here, we saw savings go up. Um, it's funny that happened a lot because of, as the Federal Reserve guy explained to us, the stimulus money. People just
Mhm.
held on to that money
Right.
for that time frame, and it actually increased personal savings rates. But you can see kind of we've trended back down to what people are able to afford and do in that space. How have you guys have you seen that play out in your practice as far as clients and things of that nature?
Well, you make a very valid point in regards to the stimulus and people. Um, the unknown to me is one of the things that attributed to that the increased savings rate is that during that time period, people didn't really know how their careers would be. They didn't know how it would be going back to the office. So, and not only that, receiving the stimulus funds, but any other extra funds that they had. People were
Hmm.
kind of holding on to it because they were like, okay, we don't know how this economy is going to come out of this thing. We don't know what inflation is going to do or if we're going in a recession. So I've got to hold on to my little bit of nest eggs
Right.
and until I get a clearer picture, which is, it's a human reaction to do that. But of
Hmm.
course, our job is to let them, know and realize that other than the pandemic, this market has been through a number of things. So, historically, that has happened before. Not on the level maybe it's COVID, but it's happened before. But if you look at the history of the market, over time, it tends to outpace, outgrow, and kind of come back from those major setbacks. So yeah, I'm seeing the same thing.
Right. Yeah. Yeah. It's funny. It kind of lends to that discussion that Mark Cuban has all the time, and he talks about and I think this is what this is alluding to in it was what you just said. In bad times we save, but it's
Hmm.
important to save in good times as well,
Absolutely.
and develop a consistent way to save and go towards our goals. So the one thing he preaches is, as business owners, you don't need a new desk, you don't need a new chair. What's wrong with the chair you're sitting in?
Hmm.
We like to kind of appease ourselves with toys and things of that nature, but at the end of the day, it's a chair. So, how is that going to help
Yeah,
your business, at the end of the day?
you, you, you sound like my partner, Eric.
I'm quoting Mark Cuban
Yeah,
here. He, and,
yeah, 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 yeah.
he has a
Mark,
little bit
Mark
more
was
than me. So, yeah, I think I'll, I think I'll follow his lead.
Right, right,
All
right.
right, so we're talking a little bit about we're going to talk about cash alternatives here and some of our options. Now right now with interest rates up, um, those two on the far right have been really attractive for people, especially over the past years. Interest rates were down, and we were getting what point
Point
nine,
seven
point
four maybe.
7,
Right,
or
right,
whatever
right.
on our savings and money market accounts. But now, I mean, I searching yesterday, I saw 2.75. Somebody told me Pinnacle Bank was paying as high as 4.25 on money market accounts. Um, so we're in a good space there. But let's talk about a little bit about cash, how it serves us both from a emergency need, household spending, and also in our portfolios that we use.
Mhm. We always, my clients always come up and everybody's got the same question. Okay, how much do I need to save? How much do I need to have as a earmark for savings? And at one point the old adage was, you want to do, 3 to 5 times, what your monthly expenses are, or
Mm-hmm.
3 to 5 months of what your monthly expenses are. So that old adage still kind of comes into play. You
Mm-hmm.
know, that's one of the first things I really ask my clients, because a lot of clients will come in and they've really done well in the qualified accounts, in the 401ks and 403bs, in the cash accounts, but they really just don't know how much to have in savings.
Mm-hmm.
Or I've got clients that are on the other end of the spectrum where they've got, and I can say it because it really is a true statement. They've got too much in savings. They've got a lot of lazy money.
Right. Right. Right.
So they've, got 2 3 years of expenses and savings. So yeah, that is always the major question. And once you kind of get a firm grip on that, you can take, get that savings to that, 5 to 6 months, maybe 7 months. And some people, if you're two income earning family, 12 to 18 months is not a bad idea from a saving standpoint from monthly expenses. But once you get that out of the way and you feel comfortable, um, then you can start putting money towards some more of those equity, those long term retirement IRA, Roth IRA accounts, and you can always add to your savings account. But I think you should at from a planning level maximize the equity side first.
Yeah. Yeah. Absolutely. And it's been tough the last year with interest rates and bonds kind
Hmm.
of being where they were. Before I move to the next slide, the one question people ask, well, how did the industry come up with that 3 to 6 month guideline? And really, it comes from historically, if people lose a job, it takes 3 to 6 months to find the replacement job. So that's kind of how we arrive at that in terms of a person saving that amount of money to kind of replace income. Uh, until they can get to that next position. So a lot of that kind of going on now, especially in tech, and where those people are going to land is kind of important. All right, so two things that are kind of hitting us now: taxes and inflation. It's tax season, of course. Inflation still, Fed's still working on that. Um, but this chart talks about some assumptions on a tax rate at 22%, return at 3%, and what does that do to your money? And as you can see, when inflation is up at where it's close to now, 6, and you've
Hmm.
got something in a safe investment, that money market account, 3, we're losing.
Hmm.
We're losing. And that's one thing we kind of have to preach to our retirees is we've they can't afford a large loss. So we do like to go fixed income, things of that nature. But at the same time, we got to beat inflation or otherwise they're going to be losing money because that
Right.
they can't buy bread, milk, eggs if we're getting 3 and eggs are going up by 4. But so the past 2 years, or especially last year, and we'll get into some statistics, but it's been rough on that group. Um, and so let's talk about a few basic concepts that apply when we've got rising markets and markets going down, especially as we're trying to take income off of that for like retirees.
So we're looking at, so and go back to your statement again in Marcus, because I want to make sure I answer you correctly.
Yeah. So let's say we've got we've got Mr. and Mrs. Smith who's retired, right? We got a
Mhm.
portfolio set up for them, and we need to take $18,000 of income off the portfolio each
Mhm.
year. Um, and you know, in our industry, we call it a sequence of events
Right,
and sequence of returns. And so, just again, from an education perspective, kind of teaching people what that looks like in a rising market and a declining market, and then you throw on inflation on top of it, and what that impact is. So we're just taking this chart a little bit and expanding upon what that impact is. And again, like we're saying, this last year it's been tough on that population because we were faced with, for the first time ever, stocks and bonds moved the same direction for
right,
the entire year. And we've always been taught they're going to move opposite, but they're getting more correlated, which is making us have to do things a lot more active on our side. We can't just throw the mud at the wall anymore and it stick and throw it in the S&P 500 and it's going to be all happy. It's yeah, those days are gone.
right. Yeah. And so in a rising market, then of course you're hoping that you set an average or a median where your assets are performing at a level, given a constant inflation number, that if it performs at that level, then it allows you, of course, to keep up with inflation. So your cost of bread in 2010 is kind of keeping up, so that when you get to 2030, we're still here. We're keeping up with the cost of inflation. And you've already determined with your advisor, whoever you're working with, whatever your downside is, or how much you can afford to lose in a changing market. Um,
Hmm.
Having that average, so that you're okay in that rising
Hmm.
market. As long as the market's rising, I'm still keeping up with inflation, even though I may have a little downturn. I've determined that. Whereas in a down market, if you don't plan for that, if you don't have a floor or a downside where you can say, well, what if you don't
Hmm.
present that scenario, you don't do that in your planning, then when that down market, or that down economy continues for a longer period of time than you expect, then you're not going to be keeping up with the cost of living, and that income that you projected that you need initially, you're not getting that there. So you kind of hope that, okay, how long is this bull market going to last? Am I prepared for it? Am I going to run out of money? And that's kind of the
Right.
end into all. Am I going to run out of money? With the mortality of people now, and people eating better, living longer. We're still using, what is that? Is it the 82 chart we're still using with mortality rates? Is it still
Yeah, well,
82 or
I've kicked mine up to 90.
9? Okay, yeah,
Yeah, I've been kicked it to 90 because
right,
yeah, I mean, people have a decent probability of getting there. But like you're
right,
saying, in that declining market, those assets, we're depleting those assets so much faster because
right,
start at
right,
100, the market's going down. It's at 90. We took 18 off of it. We're at 72.
right.
But now 72 to get back to 100 is kind of tough.
It is kind of
But in
tough, and
that rising market, yeah, in that rising market, 10, we're taking 18. We made, we took 3% of the portfolio. We made 3% of the portfolio, 4%. We're able to keep that together. So, like I said, it's something that like I said, we definitely have to pay attention to
Mhm.
when we have those declining markets to keep people on pace to not, like you said, deplete their assets. And then we're, as I had Hayward on last time, we won't get too far ahead because Leonard and I'll be back, and I'll have to schedule up a little bit later. This is the 100 level class, as Hayward called it. We're gonna get into 200 and 300 level
Right,
classes a little bit
right.
down the road, where we get into some advanced planning, uh, advanced sources of income, way to create
Right.
income to meet that. So yeah, today we'll stay in the 100 level class
Mhm.
according to CPA Hayward that we had on last week. And of course, he had to ask, "Were you gonna have your bow tie on?" So, um,
Well, of course.
all right. So here, this is interesting. So this chart is showing. Watch what happened. Is starting at what happened '08, the last recession, and
Mhm.
how look what people did when that market tanked. They took that money out of S&P 500 and it went into safety.
Right. Right.
Um, and we're starting to see the same thing right there in that 2022 ending.
In 2020. Right. Right.
Um, so this was an interesting chart that they just had just to show our behavioral finance and how we react to different things as um as we're trying to manage.
Mhm.
But at the same time, like I said, when we throw inflation in here, and that money market's not keeping up, we're losing money. So we still got to stay somewhat invested to reach goals.
Right. Right. And it would, even looking at the 2020 numbers is interesting to me is because what would also be a good number to add there is the demographics of what
Hmm.
age group are we seeing that is moving, of course, when the market's now moving more toward a safer environment,
Hmm.
is that more retirees, or do we have individuals who are still active in the workplace and still putting money in and still trying to build, for
Hmm.
that retirement? Or if we've got a larger number or an increasing number of them moving in that direction, if we do, we've got a problem because then it goes back to planning. Is that, or you got to stay in the race.
Hmm.
Um, doing those times when the market isn't performing. And so it'll be interesting just to do a little research and find out more what demographics of people that are doing that. And you can understand it, of course, to some degree as a retiree. You've worked 40 years and now you didn't expect it. So now the market's down 20% a year after you retire. So you kind of expect that
Hmm.
reaction. Again, a good planner kind of says, okay, we're in the income stage, but we've still got to have a certain percent of our portfolio that needs to stay in the market and help us to kind of rebound from
Right.
this thing.
Right. Yep. And I think these next two slides kind of allude to what you talked about earlier is, what is that cash used for? And like I said,
Right.
trying to replace income. We got the emergencies coming up. Uh, Not sure about our job situation through COVID and things of that nature, through the looming possible recession coming up. So we're thinking about upcoming expenses. Then we're also going to this thing. You know,
Mm-hmm.
do we have one or two solid incomes in the household? What's my debt level? Special needs, dependents, college coming up, investment liquidity, and and then part of it is just personal comfort level. So people need to realize that we could have too many times. I think we try and focus on what the benchmark is and
Right.
what the news said our benchmark was, or CNN or Yahoo Finance or whomever said the benchmark is. But what we're trying to develop are personal benchmarks, and as long as you hit your personal benchmark and we're able to get there with the least amount of risk that we can take, we've made it. This is
Mm-hmm.
a risk management game. It's not a return game. It's
Right.
it's a managing risk game to get the returns you need. So I think those two things kind of hit on what you've been talking about. Then here's the chart on the treasuries and what they were paying. So treasuries were, again, it's just following interest rates, and as interest rates dipped,
Mm-hmm.
um,
Mm-hmm.
that's what happened. And of course, when interest rates went back up, we had that opportunity. Everybody crashed the tips market on the website, on the IRS website, trying to get tips. I mean, on the Fed's website, trying to get tips. The Treasury inflation protected securities, because they were paying 9%.
Right.
Problem was, individually, you can only get $10,000 worth. So in that
That's it.
situation, yeah, let's talk about that for a second. So in that situation, I'm stuck, right, with gosh, if I go to the treasury, I can only buy $10,000 worth of tips for them. But don't we have some other alternatives to getting those tips in other ways and putting more money into them?
You can. You've got alternatives. You can you can look at, a bond focused mutual fund that has a higher concentration of tips in it, or you can do
Exactly.
an ETF
Exactly.
fund that has a higher concentration of tips in it. And
Right.
you can put, of course, well more than $10,000. So there are different options that a person can do and still have availability to those tips, which is kind of indirectly, but
R-
it's still tips in it. You're not on it
correct.
direct, but you're
Correct.
indirectly getting into that space.
Right. And that's kind of some of the strategies we're using now, I think, with what we're going through
Mhm.
with you know, when the market was doing what it was last year, we had to figure out what's, more of a sector rotation strategy and going into um like utilities and cash. A lot we went straight to
Right.
cash and utility funds because utilities are
Hmm.
usually still getting paid. So
Right.
they're a good source of income for our clients. And then cash just was to pull that buffer on. And then now as the
Right.
market is starting, we're starting to see the market rebound, or at least acting like it's
Hmm.
going to rebound. Now we've been able to shift some of that cash back out to the tips and back into the different sectors to kind
Right.
of
Right.
hedge against what we've been doing. So that's kind of some of the things that we kind of deal with and look at in order to construct these portfolios. So again, as we get back to savings versus investment, we've kind of hit on this a little bit. Again, best possible return with the lowest possible risk. Your savings should be safe, liquid, and easily accessible. So again, we don't want you putting money into a 401k if you think you're going to need it in the next, 6 months. Build up that savings first because we
Right.
don't want penalties and things of that as we're trying to pull money out or taking loans against it. Um, so again, those are just basic strategies. But now as we start to kind of delve into again a person trying to figure out what's right for them, um, there's a whole scenario of, as this illustrates, a more conservative approach. Probably this person here is closer to retirement, I would
Hmm.
guess, versus this person here is probably a little further away from retirement because we have more time on our horizon. And again,
Right.
that's kind of basically what we go through as we're trying to talk with clients about that construction and what we're tasked to do. Any
Yeah.
thoughts on that?
Yeah, yeah. So in looking at that, again, going back to the importance of the risk profile, I know, together, I probably said that risk profile word over 30 times in the last few minutes, but that's just really how we gear it. And once you kind of figure that out, if you're working with an advisor, um, and you kind of get the schematics and figure that out, then I mean that's half the battle, because as I look at these two, the more conservative, than the one that it looks like. Of course, there's not as much cash alternatives or bonds. One of the things I always talk about to clients is recovery time. So that
Mm-hmm.
you're really your risk profile and your portfolio allocation, whether it's your 401k, whether it's just a regular IRA, a simple, a SEP, or whatever, that allocation really kind of determines your recovery time. Meaning, between the point of where you start putting the money in and you're putting it in to where you projected that you want to retire, that volatility that you have in between the market, if you do have, several down years and you're down 10, 12% or whatever the number is, how much recovery time do you have? And that's depending on how you're age wise, where you are, how you're allocated, and which, if you really have a true accurate um, risk profile.
Mm-hmm.
So is that something that you kind of talk about too, with the recovery times, and do your clients really kind of understand that concept?
Right. Yeah. Because when we talk about, one big thing is, as you and I talk about, is avoiding large losses.
Right.
Because if we lose 50%, we got to get 100 to get back to even.
Hmm.
So it's easier to not lose than to worry about gaining. Um,
Right.
just and that's just how the numbers work out in the end. Um, so again, there can be two different approaches to it. We'll look at Ron and Susan, who first take a little bit of more speculative approach. Again, they've got apparently in this scenario they've got $150,000 in a CD that matures, and they go, okay, we're gonna break this up into 100,000 and 50,000. We're gonna put 50 in cash, 2/3 of it in the stock market, and go from there. Versus Bob and Lydia, who take a more measured approach, um, and they took their $150,000 CD and divided it up a little bit differently. More than likely, these two couples just have two different goals at this time. Both had $150,000, but they just decided to utilize it in a little bit different way. Um,
Right.
so again, a lot of times, it's no right or wrong to the strategy. It's the strategy and getting the
Right.
strategy on a sheet of paper such that we have comfort about it in order to see the success and how we're going to get there. Now, so I guess let's end with so we've kind of done a just going through
And
some
if you,
things.
you look
Yeah,
at
go ahead, Lynn. Yeah, go, Leonard.
okay. No, I was going to say, and you were talking about, different strategies and different approaches. And of course, people in that scenario, you have two couples with the same amount of assets, but the way that they've allocated is totally different. And like you said, their strategies are different. Um, and can strategies be changed? They can be changed. You can change. You may start out and say, hey, I just want to. This is my goal. I want to create X amount of assets for the next, 5 years. And then in 5 years, something changes totally. Oh, now, I think, when I'm done, I'm going to just be traveling all over the world and I want to do consulting. So now your goals have changed.
Hmm.
And the strategy may have to change because, the first, few years, we were in a place where we may have been in the middle of the road, a little bit more conservative. But now we're talking about needing more assets at the end of this retirement period. So we may have to change the strategy to be a little bit more aggressive. So, it's not like, we don't want to put you in the car and never change the tires on it, but we want to at least buy some really, really good tires so we may, get as much mileage out of
Mm,
them as we can. And if we
right.
get to the point where we say, okay, yeah, now we can rotate the tires or change the tires, let's do that. But that was just a good example of how you can have the same amount of assets, but your goals and your strategy can be totally different based on what your end game is.
Exactly. Which goes back to really, like you're saying, creating options and different options off of the strategy. So, probably last year we had a bunch of clients that were ready to buy a house, and
Hmm.
then rates rise, and it threw off the strategy. We got to
Yeah,
move that down, or gosh, that we got to buy a smaller house. So, so our job a lot of times is to show them those different levers so that they have an
right,
informed decision on how to pull which lever but still stay on point
right.
with where they're trying to get to. So it's really it's fun for us. I think we both enjoy working with clients and the
Absolutely.
seeing the outcomes and helping them get to where they
Absolutely.
want to get to. But it's getting
Absolutely.
more complicated. The you're seeing online that 60/40 portfolio is dead.
Yeah.
It's a lot more than we used to have to deal with. I'll just kind of leave it there for this one for this conversation today. In closing, we just hit a few things there. Anything you want to add in closing, Leonard, on what we talked about here today?
Just yeah, just being consistent. I mean, there are a number of resources that are available where you can go out and you can take a risk profile questionnaire. You can find out, the type of investor you are, your type of investor you want to be. But it's just understanding that, taking your resources, your cash flows, your income that you're coming in, and allocating those um, in the right directives and right places. I mean, it's really going to help you win at this end game. And it's so is important. When you showed, I think it was the first slide that you showed, Marcus, where it was showing the different FICA scores.
Mm-hmm.
Um,
Mm-hmm. Mm-hmm.
it was the first slide, right?
Yes.
But I just, I'm not sure, and I think people are starting to get to the point now where they really realize that, man, managing that wisely and efficiently really can have an impact on a lot of long range planning that you're doing.
Yeah. It's funny you mentioned that as we now go ahead and pull this up. As we start to look at the rest of the series of things we'll talk about. It's funny you mentioned that
Mm-hmm.
the next one I'm doing is February 28th with insurance. But that that credit score impacts your insurance rates, your auto rates.
Absolutely, it
A lot of
does.
people don't really realize that, but it's not your driving record. Holy, it's they're pulling that credit score, and that's how they're figuring out what they're gonna charge you. So it's that credit score, your employer's pulling that credit score a lot of times to learn,
Mm-hmm.
what type of
Mm-hmm.
person you are. So it's impacting a lot of things, as you say, going forward, and really boils back down to finances.
Sure,
Yep.
sure.
Yep.
No,
So
great.
yep. So again, yeah, we'll end up here. Just wanted to give you guys kind of the upcoming schedule. I moved this one up. I wanted to do it on the 14th, but I figured next week was Valentine's Day and probably wouldn't get a whole lot of follows. So we pull this
You
one up.
might have had a great view. You might have had a
Yeah,
great viewership.
I don't think so. So move that one up. So we'll be back February 28th with insurance. And then this little series here, 14th, 20th, April 4th. These are all Mr. Brooks here coming back. We'll get into the 200 level
Mhm.
classes as Hayward said,
Right,
200 level, 300 level classes, really digging down on more investing principles,
right.
how we do things, looking at retirement living, investment strategies for retirement. So we'll get into, how do we take income? Which bucket do we pull from first? What is its impact on these other areas of our life? Trying to make that money last as long as we can. So yes, you all definitely be in tune for the 200, 300 level classes in this series. And then I think I got you back down here, Leonard. Um, you back down here somewhere else. I think maybe
Make
April
sure.
25th. But I'll let you know.
Yeah, I'm
Um,
March 28th, April 25th. Yeah,
April 25th. Yeah. So
keys to investment.
we'll make that the 300 level class and
Got
go from there. All right. All right. Well, again, man, I appreciate you for jumping on tonight.
No
Don't let them
problem, my friend.
grands
Anytime.
don't let the grands wear you down too much tonight.
Oh,
So you can make it
boy,
back to
that's
the
how
office next week.
I'm absolutely, brother. I
All right,
appreciate you.
buddy. Well, until next time,
Okay.
y'all, we will see you. Thanks
Okay.
everybody for tuning in. Take
Thanks
care.
everybody for tuning in. Take care.
All right.